Building a startup from scratch is tough. My name is Justin McLeod, and I'm your host for a new podcast series called Back to the Basics. In this show, I'll be talking to startup experts as they discuss the fundamentals of launching and running your first tech startup.
When it comes to just running a business off of your customers and building it with them, and just kind of bootstrapping, that is probably arguably one of the best situations for the founder to be in.
Congrats! You finally got your first paying customers. Now that you have some money coming in, managing that money is the next step. In this episode, I sit down with Durantae Lucas, the head of finance at Atlanta Ventures, a venture capital firm based in Atlanta that has made investments in startups including Calendly, SalesLoft, and Terminus. Durantae will share tips on how to maintain cash flow, create a financial plan, and optimize your spending. Enjoy the show.
I'm Durantae Lucas. I've worked at Atlanta Ventures for the last 6 years, since like 2014. I run pretty much the finance and the accounting there. And, initially it was, when I got there, it was companies as early as Terminus and Calendly working out of there, and even SalesLoft at some point. So I got to kind of have interactions with some of those companies in the beginning. And then now we've kind of got we've got Greensy. I don't know if anybody's heard of that one, the In-Town Golf Club. And so we're doing more of a studio model. So my role's evolved a lot as the companies have changed. So been able to see a couple of things.
Dope. Well, cool, man. So yesterday evening, we got a chance to talk to Michael Mazur, and he kind of just broke down just like, just different ways of how to raise funds, family and friends, seed round, what's an angel investor. So he broke down kind of like all the terminology things. So I really want today kind of just to, go a little bit deeper and just like once that money is kind of received, just through a customer or through an investment or family and friends, like, what will be those next steps for those founders? So to kind of kick it off, let me see. My question would be, so what are some of like the basic like accounting and finance things that, first time founders, they should have in place, before they, when they first starting off? Like what are some foundational things on the finance side that they should have?
Well, I think early on, you're probably going to want to look at stuff from just a cash flow basis in your mind. And I'll just say, if you don't have more of the background to know how to do the right stuff, from an accounting standpoint, I would just kind of chiefly focus on cash flow, and what that would mean is being incredibly organized with your outgoing and incoming, expenditures. For me, I would be using some type of financial software like a QuickBooks or Xero, or there are some other ones that are more hybrid where the main function of the software is so you can invoice the client, but it also provides financial data. But ultimately, you'll want to just be chiefly, on top of cash at all times. So, the organization piece is probably really, really important. I most times will say that likely comes in the form of some type of financial software, like I said, like a QuickBooks. Or if you're really good about being organized and don't want to spend the money, you can just use Excel, or your credit. I don't recommend it, but I mean, sometimes you have to do what you have to do. So say organization is really key, and just having a mission for what the cash is going to be used for.
That's dope. And also yesterday evening, man, we were talking, Michael was talking about like the best way to kind of fund your company is through customers, just basically cash flow, kind of like bootstrapping, not bootstrapping, but just, cash flow essentially. So I know that you have, just working with, Atlanta Ventures, a venture firm, you've seen just different type of companies, essentially with different type of goals. So could you kind of like touch on like your perspective from a company that's strictly focused on like just cash flow compared to a company that has received like some seed investment money? Like what would be those two, I guess, their strategy or their approach to their startup.
Gotcha. So I guess it could get complicated, but I guess the thing I'd say is when it comes to just running a business off of your customers and building it with them, and just kind of bootstrapping, that is probably arguably one of the best situations for the founder to be in, because, as you're building a business, the thing that you're looking for are incredibly passionate clients to be using your software and kind of be that word of mouth for others. So if you're able to build the business with customer inflows, they'll most likely be kind of the voice of the product for a while. They'll be like your client success team, like your outsourced success team for a minute. And that'll allow you to get more cash in. And then at the same time, you both kind of get to build it with a vision in mind together. And almost more importantly, you're kind of on your own timetable when it comes to you kind of raising cash kind of through your client base. Mm-hmm. If you start to finance your business via whether it's an angel, whether it's friends or family, whether it's a big venture fund, or if you get it from somebody else, no matter who the somebody else is, there's always going to be another expectation related to the cash. And depending on how much ownership they have in your business or influence or voting, it can take a variety of forms. People always talk about taking smart money versus dumb money. And that's a lot of times just speaks more to an investor's value in your business. But I'd say, that's incredibly important, but I'd say at the same time, may even be more important to make sure you have a great relationship with somebody and they kind of understand your vision for the business as well. So the challenge with, I would say cash versus raising outside is once you raise with a third party, you do have to incorporate their expectations along with the customer. Because in both situations, you still want to prioritize like staying as close to your customers as you can or your clients. But with cash, if you just raise the money through the customer, so to speak, then I think you have a lot more flexibility. If you raise it, I think it can kind of put you on a certain trajectory and a track, and that's okay as long as you're aware of like how that may play out for you.
Gotcha. And then you talked about saying depending on like the vision. Could you talk about like the importance of, I guess, financial planning? Like creating milestones. We talked briefly about that yesterday. You called it kind of like inflection points. Different points or turning points in your business. Require, I guess, different strategies, stuff like that. But could you talk about, before they even start bringing in customers or even thinking about raising money on their hands, can you talk a little bit about just like the importance of that planning process?
Yeah, a lot of times when people come, let's say they come to ventures and they're like, oh, we want to do X, Y, Z. If we haven't seen a lot of traction in general, or, most times we're kind of pointing them to say, hey, try to get your first 10 or 100 clients, 10 if they have none. And then, if they're in that midpoint trying to get to 100 or so. So I think you can kind of create these kind of KPIs, if you will, within your own business. And a lot of times it's going to be customer focused because that's where you are, and that's kind of where you should be as an entrepreneur. It's like, clients and product are both of them. But as far as financial milestones go, I think, customer milestones are good because a lot of times they'll help drive it. But knowing what you want to do next, right? Like if I'm running a business, I'm like, man, I'd really want to be, have an office out of Tech Village or something because I think that it will help grow my client base for this reason. I know what amount of the rent is. I know X, Y, Z. I know like, hey, in order to do that, I most likely need to have X amount of clients. And so I think a lot of times they can be a really good indicator of an inflection point, or it may be that you need to hire somebody and you finally get to a point of, hey, if I get to X amount in MR or recurring revenue or just cash in general, and you're like, okay, I can afford to hire somebody in marketing or sales to help continue to drive that pipeline that continues to grow the business a bit more. So just, I think, yeah, it's incredibly important to have a vision. Just make sure it's your own vision and you understand what your own vision for your business is. But I think really, really early on, most times it's just going to be, how can I add clients? How can I do, how can I create a product that's going to be received well and, meet your expectations and the client base's expectation.
Right.
And as far as, using tools, they're on Atlanta Ventures website. It's, let's see. If you go to atlantaventures.com/content/tools, they have a lot of, towards the bottom, they have all tools, or to the left. And if you click on it, you can see a startup budgeting tool, and simple strategic plan. So those are some items that you could use to kind of try to begin to create the vision for what your business might be about. Because even though, early on things may not be happening, if you are going out to raise, you do want to kind of have a plan for what you're going to do, like a vision for the next, few years at least, because somebody might say, okay, what's the next 5 years look like if I give you X amount of money? It can't necessarily be, it can be get this amount of clients, but to get to that amount of clients, in reality, there are economics behind it. Like it probably takes a certain amount of people in this department or that department and a certain amount of build out. So I think that's pretty much it. So just, I think, figure out where you want to be and just kind of back yourself into it if that's helpful.
Right. And I know that, you correct me if I'm wrong. I think, first starting off, there's like really just three different kind of routes, as a startup. You have, bootstrapping essentially to be a lifestyle type of business, for example, like a MailChimp that hasn't raised zero capital, but they have, a lot of revenue and a lot of users, which they call it a lifestyle business, compared to, a company that is trying to grow really, really quickly and get acquired. And then the third one is just like, okay, you're trying to grow quickly, but then, you don't want to necessarily get acquired, but you want to go IPO. So am I missing anything in regards to like kind of like those three kind of paths as far as like a startup? As far,
I mean, you can have that, and or you can have something. I mean, like I said, you said lifestyle, or you can have some that aren't going to quite give you that lifestyle, but there's still pieces of cash that could come in.
Right.
So they could kind of fall under that same umbrella. So no, I don't think that's too far off. I mean, you could probably bucket most of them like that. And of course, there are different paths, but to be honest, I don't know if all of them start out that way. I think a lot of entrepreneurs, and not all of them, right? I think a lot of them, if they're starting out, kind of have like man, I want to do this, like kind of have like a huge, big idea about it. And then sometimes you can notice what's happening with the business and say, you know what, okay, maybe it's not going to grow at this trajectory, but it's doing this, maybe it's growing modestly, but it's still providing me, a couple $100,000 in income every year, or $1 million every year. It's not, you're not going to be able to necessarily retire off of it per se, but I mean, that's a decent amount of money to come in, and you can either use that to take on another venture, or just invest in other items.
Gotcha.
So I think that those things can evolve, and there are some people that maybe don't think about IPOing, and then as things change and it just gets out of control, it's like you can kind of get enticed to do it. So, but yeah, I think there's different strategies for each of them.
Right. And then you mentioned like Atlanta Ventures has like a budget tool. So like for yesterday we were talking to Michael. He said that he was with a startup that they blew through $42 million and had to basically, definitely go out of business. So could you tell, as a first-time founder, I know London's not on here, but he wanted to get on this. I think this was great. I'm recording this. So, but as a first-time founder, can you talk about just like budgeting? Like when you get, it don't matter, $1,000 or $10,000 or whatever it is, budgeting. Could you tell us like your perspective on like budgeting when you get money?
Well, I think it still just all goes, for me, it just all goes back to the idea of having a plan, like a well-defined plan, and then just sticking to it. So if you say, I've got $1,000, you're like, all right, great. I want to spend, $400 on vendors to make this happen, and I'm gonna buy these supplies for $200, and that's gonna leave me $300 for this time period, and that's what I'm gonna do. What budgeting isn't is getting that $1,000, having that in your mind, and then but just going to spend $900 on something completely unrelated or outside of the scope of what your plan is. So a lot of times it does help to write it down and really stick to it. And you got to revisit it too. It can't be something that you're like, all right, cool, 42 million or however much money, and then you're like, all right, that's that. I know that's how much I need, and then just not have an idea for it. So I would just get as minute as you can, and by time periods, and hold yourself accountable by it. Most times when I'm making a budget, a lot of times you're going to start with kind of what are your inflows, right? That's kind of like one of the first steps of what are the estimated cash that I'm going to get in. Do you have a pipeline? And to kind of keep yourself honest about revenue forecasts and things like that is, do you even have the pipeline right now to truly support what you're even thinking you would be getting in? Or do you have enough traction to close some deal? Because, we can always kind of talk ourselves into bigger numbers or whatever else. So it's kind of keeping yourself honest about cash, because that really can affect a lot of stuff. And then from there, you kind of want to go to any big capital expenditures that you might have. I mean, starting out, you probably won't be buying any huge like PP&E equipment or anything like that. Depending on your business model, you might. And then from there, of course, like payroll is going to always be like your largest cost for the most part. And that's typically why even in this COVID environment, we see one of the first things companies do, unfortunately, are cutting people, because that's a pretty quickly controllable cost. So at the same time, you keep that in mind as well. You have to kind of figure out, what are you able to do singularly as a person? What can you accomplish? A lot of times founders aren't really paying themselves salary, or they may be, but sometimes they're probably not as much as they want to be paying themselves. But you really just have to be honest about what you can do by yourself. And then if you need to invest in somebody else, kind of taking those steps. A lot of times I would recommend, of course, using like contractors initially, and most people will do that. But again, as you're spending that cash, hold yourself accountable by reminding yourself what the overall goal is. So if I say, in startup terms, everybody's mostly concerned with, we talk about revenue, but we talk about burn, like how much are we burning month to month? And the burn is pretty much essentially translated into how long before my business runs out of cash. And that's what you always have to be concerned with as a founder. You cannot let yourself run out of money, at least without you knowing that it's going to happen, right? Like, there needs to be a clear date. If I'm going to, like, say you have $1,000 and I spend $333 every month, in 3 months, I should know I'm going to be running out of money. But if I know that, it's fine, and I can make plans according. And I know you didn't ask about this, but I'd say related to running out of money, I've kind of talked about this before, but you want to make sure if you are going to be reaching out to get money from third parties, that you don't wait till you're completely out of money to do something like that. You want to make sure that you're building those relationships when you don't need them, so that, when you are kind of getting closer to, running out or things are going different, your ask isn't the first time you've had an interaction with an investor or a debtor, like your bank or so. But there are also a lot of software tools that you can use too to kind of help you keep stuff together. So
yeah, I think that's good, because I think a lot of, in the startup world, you hear the word the burn rate, and not a lot of people are familiar with that. But I think you definitely broke it down, just saying that's just like the day that you don't in your bank account.
You got $1 million and you're burning $83K a month. Yeah, you got about a year, and that's about it. So so that's most times when people are looking at burn to see what they're essentially just looking to see, when am I going to run out of money? Because that clearly affects your decisions in the first quarter, the next few quarters, depending on how your whole sales process goes. And again, that kind of ties back to what I talked about with forecasting for revenue. What you say you can do you even have the pipeline to support it? Do you have the right marketing piece in place? So that's pretty much my take on it.
Definitely. Well, cool, man. And I think let's see. All right, this right here. Okay, we touched on that. So you talked about QuickBooks, you know what I'm saying, about just kind of like the money that's coming in. Say you have, um, what's it called? Just cash flow coming in just from either users, signups, whatever it is. Um, can you talk about just like, I think in the startup world, I think in the small business world, they talk about like, taxes and things of that sort. But like in the startup world, I don't really hear that conversation being had in regards to just like, when how to prepare yourself when it comes to the tax season, because essentially if you're getting money coming in, you essentially have to pay taxes some way, some form. So I know you talked about QuickBooks and you mentioned using independent contractors. So could you kind of touch on just like the first 2 years of I think
Mm.
majority of these founders, like the first couple years in their business, should they worry about taxes, or how important should that be in regards to like with this money coming in and spending money and things of that sort?
I got you. So I'd say, of course, make sure you got I would make sure I already have a business created. So I wanted to bring it up just to say, because there may be people that are just working on a business, building a business, but like haven't quite formalized everything. That's, of course, like one of the first steps, just to make sure you can tie stuff to it when you file your returns, right? And, typically for our businesses, we start 100% of them for the most part as LLCs. And that's mostly so that you can get a lot of that flow through benefit. Because usually when you first start a business in the early years, you're going to be losing money a lot of times. And so you want to have that kind of benefit to net against your income coming in. So the way about doing that, of course, as I talked about, using the QuickBooks, using Zero, you can use Bench, however you do it. I mentioned being organized and how important it was, and that's the reason for it. So if you have a credit card, that's you trying to separate a personal credit card from a business credit card, to try not to have like commingling of funds. So, like everything that I did on this card is specifically going to the business. And of course, a lot of those cards and things will tie to a financial software like QuickBooks and Zero. You can go in and I would keep stuff simple. Like I get like everybody's not a bookkeeper or an accountant or whatever else. And so I would try to keep everything as simple as possible. Just your expenses as expenses, income as income. Only thing to really keep in mind is when you start to put cash into the business, those are kind of like contributions on the equity side that won't show up on a P&L per se. But ultimately, it's really just literally about being organized. And I think software, of course, is like one of the easiest ways. If people can't afford it, you could just pay somebody to do it month to month. But I think early on, most of us are trying to be scrappy. And so that's just getting the right information piece in, right? Like you have exactly what your numbers are. Things, I mentioned the structure of LLCs just because they are flow through. So again, taking those losses from the business and being able to benefit from it personally is helpful to kind of reduce your own tax liabilities.
Yeah, man. I think I want to kind of unpack a couple things in there. So I guess number one would be the structure of the company. So I know you said like LLC, so that's kind of like pass through, and then a lot of startups, they are like Delaware S corp, C corp, C corps. How
Right.
I know how do I know that's kind of gets into like the legal side of things, but like how does that affect in regards to like the taxes and stuff like that?
Yeah. So we mentioned the first 2 years. So I'm assuming in the first 2 years, you probably haven't quite raised any capital yet. So I think in the meantime, it's good to get a lot of those personal benefits. And it depends. So if you start to raise money from like these, funds, they most likely will require you to convert to a C corp. And from there, a lot of time part of it is that they don't want to get a whole bunch of K1s because when you're LLC, you file and then you put all of your activity on an item called a K1, and that's what people use. But all these funds, they invest in hundreds of companies over all this time, and it would just get incredibly messy. So I think it's a lot easier to have people convert. And so from that point, you don't get the personal benefit anymore of that flow through because a C corp would not be a flow through entity. And so so a lot of people, they will file in Delaware because I think they have kind of more favorable business kind of rules for them, maybe
Right.
some ease of filing things
Mm-hmm.
related to it. So yeah, you will see that a lot, and you can start out as a C corp, and that's no problem. But just kind of keep in mind you won't get benefits of the flow through. But honestly, maybe that is easier for you at some point, because most times you do have to pay something to convert from an LLC to a C corp. You'll want to use like either your tax person or like a lawyer to try to do it.
Right.
Uh,
Right. No, no. And you also mentioned about not commingling your funds.
yeah,
Yeah, can you talk about just like separating your business and your personal? You know what I'm saying? Having like a business account compared to like your personal account, and not making sure that it doesn't get crossed over.
yeah, absolutely. I mean, and for me, it's as simple as literally having separate ones. I think to try and do both, you kind of setting yourself up for a level of failure. Maybe you're just that organized. You're like, nope, I know how to go through each month and just switch out these transactions. But not that you will get audited immediately, but some stuff starts to be subjective. You're like, is this really your business expense? Is it not? So, I think overall it's best to just make sure they are separate. And if you have a credit card, it means trying to file for a credit card in your business's name, and doing the same thing with a bank. So if you have a local bank that you have a great relationship with, try to start a business with them. And you likely be guaranteeing it to an extent, which is fine. But it is really important, and it's going to make stuff so much easier. Again, the organization of everything is going to be really key. And part of why you would do it, you might be thinking that, hey, I was able to acquire this client by spending X amount this month, but in reality, maybe it was a lot less, and you just kind of had some of your personal expenses in there, or it's things like that. So you just want to keep them separate as best you can. That means your own bank account, your own credit card. In the meantime, when you can't do it, that's just you being very deliberate. I would say weekly or monthly, going back, and probably whether it's exporting a file from a credit card if you're using it to commingle stuff, but literally marking them and then treating them as if you kind of distributed cash or, to yourself and then used it for the business kind of thing. And that's part of why it gets complicated, right? Because if you're using your own personal cash, not distributed, it's like you contributed. So it's like, if I'm using my own separate personal bank account, and it's really for the operations of the business, the way that normally should have happened is I would have put a certain amount of money into my own bank account, like written a check, that would have kind of went to my ownership percentage. Like, hey, this would increase my tax basis. Like, I put in 10 grand into my business. Cool. And then I swiped 10 grand worth of business expenses. But, so without doing that, you kind of miss out on some of those things, some of the like technicalities of it. But it's fine. It's not the end of the world if it happens, but you have to be so organized about it that it's just much better for you to make sure that they're separate, because there could come a time where maybe that time period of your business is under scrutiny for whatever reason. And, if it's like, oh no, I was using my personal account to do this is really for the business. It's not a great idea. But
Right.
if you can't avoid it for whatever reason, right? If there are just limitations, so like, you've tried to open it up and for whatever reason denied or whatever else. All right, that's one thing. But, I think there are some avenues for that. For people who've raised a certain amount of money, of course, you can use like Brex, which is like a secured card. Some banks might offer a secured card where it doesn't have to use credit, and you essentially kind of build up your history with them before they issue a credit card if you don't want to personally be liable for it. So, those are a few options. So I don't know if I rambled a little bit on that one, but.
Oh, no, it was good. Just keeping them separate. And then also, man, I think you mentioned about just being organized. Me as an entrepreneur, so I pick like one day out of the week where I literally just sit down and I just look at all the finances. You know what I'm saying? Just like look at, okay, what do we spend this week? What did we, what did what did we come in? What money came in? Things of that sort. But also, man, I think we touched a little bit briefly on taxes, but like I know there's like different quarterly payments, in regards to like tax, like self-employment tax, right?
And
Can you talk about like, oh, you hinting on this too, but like essentially say you're starting to generate revenue, right? You have this cash flow coming in. What I did, but I create like a business savings account where essentially whatever money that's coming in, you putting some money aside just for, whenever that quarterly payment is ready, or that quarterly date hits, you can kind of just put some contributions towards that. So could you touch on like, putting money aside throughout the year, what I'm saying, for those taxes? And then also, it's a two-part question. So one about that, and then the second one would be once money comes in through your business account and then paying yourself, what I'm saying, like what that looks like.
right. So I think technically a lot of times you're supposed to give yourself a guaranteed payment can be outside of payroll. So it can be, just true cash to you. And then from that point, you still have to pay like certain withholdings on it. So, and you can choose the frequency of it. A lot of companies kind of will just still put themselves on payroll, like kind of have those withholdings happen for you instead of just taking a full guarantee payment. So let's say you made $100,000 or something, instead of getting that 8,333 every month, you net the 833 less the taxes every month, just like a worker typically would. So I think if it's possible for you to kind of enroll yourself as a worker, then I would do it. But I know early on you may not be able to really put yourself on a payroll per se. I think I've told people maybe put like 30% to the side of cash that they're claiming to pay themselves. And then of course, as the business flow throughs, whatever income is going to come to you anyway, and you'll have to pay taxes on it. So as far as you mentioning putting cash aside, you can, the way you mentioned it, like having a certain savings account, and you can say, hey, for every X amount of cash that comes in, I'm going to put this to the side for this payment. That works fine too. Some people may not work like that and they got enough cash. They're like, yeah, I'm not worried about it. And, but it is just, good to make sure you have, figure out your own kind of cadence, because you don't want it to surprise you. You don't want to be at the end of the year thinking like, okay, I've got this amount of money, but, meanwhile, you really don't. You got, a lot more you owe.
Right.
And so if you can talk with like a tax professional related to it early in the year, I would, just to kind of make sure you're like, both of y'all are aligned. Because I'm sure just even having a consultation with them makes it like a little bit easier. So you're well aligned with what you're already doing, and kind of moving forward. So wait, I don't know if I answered the second question, but I feel like maybe I started with the second question.
Yeah, you answered both of them. And I was gonna say, so yesterday, like I said, we were talking about raising funds for your startup, and one of them were the 3 F's: friends, family, and fools, right? So especially like just starting off, what I'm saying, like of course the stage majority of companies here are like just kind of getting things rolling. Could you talk about like, because you've seen different cap tables, right? Could you talk about like how would you structure a friends and family deal? You know what I'm saying? Like if it even needs to be structured, you know what I'm saying? So if I'm, your friend, you know what I'm saying, you about to start a new startup, I give you $5,000, like, but I still want like some form of something. What would you say would be the best way as a founder to approach that friends and family round?
So I'm just gonna say that no company I've dealt with has done one officially, right? So most times, if you do it though, you do want to make sure that the expectations are clear. Earlier, I talked a lot about alignment. I talked about smart money, right? And I talked about how maybe even more than smart money, even though this can be looped under smart money, the making sure the vision is very clear for both of you, and understanding that family member, that's a relationship. And so just making sure that they know that, hey, they're not going to spend 20 grand into your business and then they're getting, 100 grand next year or 40 grand next year. It's, making sure they understand every implication of it, the long haul of it, and just keeping that communication open. The last thing you want also is somebody, a family member just because of the cash to get them in, but they're really a headache, especially if later on you're going to raise with investors, because they may put, they're going to likely push them out at some point. So it just depends. And, so I think I've seen somebody talked about that they issued common stock to family or something like that. But you can talk about the technical structures of it, like with the lawyer, and I won't pretend to tell you like do X, Y, Z. But what I will say is more important than anything is that the understanding is incredibly clear, because if that's not the case, you're gonna run into a lot more problems than just the structure. Also, make sure that things are a little bit commensurate with where you're at. So don't try to raise some, I don't know, like 50K on some just crazy valuation. Whatever it is. I would maybe I would probably try to keep it more as like a debt that could convert at some point. I try to keep it as simple as possible. Maybe even just a debt that had like some interest terms to it is what I would do for like a friends and family kind of thing. But I know that people actually issue shares at some point. And maybe that's something that you can kind of build into it to where, you can choose once you go with another investor to pay that off and then, take care of them, or just convert it anyway. But that's kind of my take on it.
So, and you talked about just communication. And Michael, he was breaking down just like, the friends and family compared to the angels compared to VCs, how communication with them is, it varies. But I know dealing with different portfolio companies with Atlanta Ventures, how important is it to like communicate with people who have, put money or put contributions to your startup company?
Yeah, it's very important. Unfortunately, sometimes even when you are very careful, you still can have somebody be on a cap table that can be, troublesome for the entrepreneur. Meaning that, they're very demanding and they want a lot of stuff, even relative to their own economic control of the business or control in general. But, you still have to kind of take care of everybody. And so that's, if you can vet as best you can. And that wasn't an anecdote from anything personally I've seen. I'm just saying in general that can be an issue. I have heard somebody else tell me that outside of the portfolio.
Mm-hmm.
And so, as I mentioned, the dangers of raising from family is, these kind of differences in expectations that are kind of, they're not being met. The same thing can happen with an angel. Keep in mind a lot of the whole, raising via Regulation B or issuing stock under those things kind of just requires, for the most part, people be higher net worth before they can invest. There are a lot of other rules too in there that you can kind of check out under that regulation, but most times it equates to somebody being higher net worth. And if they do that, that's fine. But again, I think this ties back into the whole smart money thing, where even angels can be worse than a friends or family. You know what I mean? But I guess there's a stereotypical type of communication with family versus them. So I mean, in reality, you would be expecting an angel to be a lot more, be slightly more sophisticated, depending on the space. And then of course, funds and banks and other things have their own kind of cadence. Banks will, definitely have their own. They will require you to have a certain type of communication with them. As far as smaller funds, like ones we've dealt with, there's, typically an entrepreneur sending out some type of monthly update, their numbers going out to them, and they have their own relationship to build with the investor. There'll be some that, likely the ones who lead you around, you probably have a strong affinity for, and you'll just want to continue to build those relationships because they are really good partnerships. So they're going to help you, going to help make intros for you. They're going to help guide the business along with you. And they're really going to be the ones that believe in your vision also. So it is really important. And it's, and just because they're friends and family doesn't mean they don't need communication, because everybody's going to be, if they put money into your business and you accepted it with, you're going to build it, they are integral to the success, in some shape, form, or fashion. But I personally would not take any money unless there was an understanding of the expectation.
Right. And back in one of our first couple of I think Morgan mentioned about how he meets with people, and he asked them to kind of join like his like email list so like he can send them like different updates. And I thought that was pretty cool, just like for especially for first time founders to kind of like send some form of cadence or some form of consistency with updates, even if you're not raising any capital or
Yeah.
if you introduce to somebody, you know what I'm saying, just to kind of get that flow. Because I've seen like been on the email for an investor update, and it's dope. I mean, it's really cool to see like a startup's growth. I think I'm with Long Tap, Wilkinson.
Oh yeah. I like
Yeah,
him.
man. So
Very
on
cool.
his investor update thing, and it's cool to see. It's just from starting off from like scratch from a program to like you getting up there in the six figures in revenue. You know what I'm saying? But I thought that was a pretty cool thing to do,
And,
even if
and
you.
and to that point, for Greensy, we have updates that go out to investors, but also at the top, it's like, hey, if you no longer like to be part of the communication. So it's not just for investors, like investors and people who support. So it's a great idea. And earlier I mentioned, how, keeping aware of when you're going to run out of money, but also maintaining a good relationship with people that you might be thinking about raising money from well before you need it. And so you mentioned having people on an email list, and that's kind of part of it also. Your communication doesn't necessarily always have to be a call or trying to get somebody on coffee. It can be updates about your business to where they feel like they understand the journey of where you've been going, where you're at. And then you can kind of reach out to them separately at times and use that, a thing that you would do anyway that's helpful for you as a founder to understand, hey, yeah, where is my business headed? Did I lose a lot more clients this past month and quarter than I thought I was going to? Did I grow exponentially? And then you have ask in it as well. Try to bring in people into your story. And I think those are good opportunities to do that. Something like I said, to a good point to have them on an email thread. You ask them, of course, if they wouldn't mind, and you
Mhm.
give people the option to opt out as well.
Yeah, I mean, it's kind of some form of like self accountability, because it's like you could be kind of work hard and grinding or quote unquote real busy, but then the numbers kind of show it. You know what I'm saying? And it kind of forces you to give that update to other people, because then you can look at it yourself and say like, okay, like the things that I did, it didn't really align with what I projected to do. You know what I'm saying? So it's kind of like some form of self accountability and showing progress as well. But
Yep, then understanding the economics of what's happening, certain things, certain people I've seen say, hey, because this event is going on right now in the world, this affected revenue in this way. So yeah, it's incredibly helpful for.
yeah. Um, and then a couple of terms, and I'll kind of just throw it over to some of the founders to ask questions. But just to hit on terms, some people kind of just, for me, I know, at least for me, I'm gonna speak for myself. When I was first got into like the startup world, like people just throwing terms around. I'm just like, yeah, and I'll just go around and just kind of Google it. But could you break down? You mentioned cap table. You didn't mention this, but like points. You know what I'm saying? Like I think those are two terms that are often used in the startup space, because you kind of break down just to kind of demystify what a cap table is, and then what it means to like get somebody a point like an advisor or something like that.
Gotcha. So I imagine what they're talking about is just percentages in the business, and uh, I think when you listen to like a stock market ticker and they're talking about the Dow's down by 100 points or some kind of thing, they usually translate to just a percentage. But for the most part, if you have advisors or you're trying to somebody you want to give a piece of the business, you usually have a certain you have like a pool. It usually equates to about 10% of the total existing shares, and it can vary, but a lot of times you want to give them that a piece of that ownership to kind of reward them for whatever help they've been doing and incentivize to keep them in. Sorry, I'm not gonna lie. I think I forgot the first question that you're asking.
The cap table. The
Oh,
cap table.
cap table. All right,
So
cool.
what is a cap
Perfect,
table? Like,
perfect.
what does it look like? Is it
Cap,
often updated? Yeah.
Yeah, so the capitalization table, the cap table, just essentially is almost like it's a statement of the ownership of the business. And it's helpful because things can get complicated in there, right? Like you'll have, it tells the present story, but the cap table is just a spreadsheet that shows people's ownership percentage. That's all it is. It shows, total existing shares, who has the preferred ones, who has the most percentage overall. But in reality, a cap table could look the same for one company to the next, right? Like you could own 50% of, X company, and I can own 50% of Y company, and the same investor can own the other 50% of the other. But that doesn't really tell the whole story about the ownership in the business. I think that's good to keep in mind. A lot of where the action happens with like the ownership is going to actually be in the operating agreements and, the docs that show, what kind of preferences do the investors have? So, are they getting a 1X? Are they getting a 4X? So the same money that you see on the cap table, it may be a little bit more significant to a business depending on what the terms in the agreement are. Some people may have a certain level of economic control. They may have a lot more voting rights. And so, even though by percentage wise, sure, they have a certain amount of shares, but, also don't get too caught up in just the cap table, because a lot more of the stuff that affects an entrepreneur's ownership and, decisions that they can make in the future are not on that cap table. They're actually inside of they're inside of that 60-page document that people, send aside. But for the most part, it's going to should show a history of how many shares you've issued, people's percentages overall, and, preferred versus common and your actual allocated, option pool at the bottom, and just kind of keep a good overall view of it. You shouldn't necessarily have to update it all the time. Just most times after some type of financial event that affected ownership, and a lot of times for us, it's when we go to raise funds, or if there's, you did some kind of note that you need to put on that has the possibility of converting. So those type of things. So
yeah, and then you mentioned like really it's all about in between the lines, like not even really the cap table. It's really about what's in that agreement, because we talked about yesterday about rounds, about your seed round, your series A, whatever, your pre-seed, things of that sort. But I don't want to get all the way in depth with that, because I know you got a lot of knowledge in that space. But can you touch briefly on, like, for instance, like you talked about a convertible note, you know what I'm saying? Like, note, everybody knows a note, that's debt, but like convertible note, like how did that look, when you go to a different round, or even if, somebody came in or seed investor, it's a different valuation. Like, can you talk about the basics of like the rounds for investors?
Yeah. So, I mean, of course, typically the earlier on you invest, you're taking on a bigger bulk of the risk. So, but the company's not worth much, right? So you're going to put in a certain amount of money, $5,000 at some valuation early on. And then the same $5,000 after round 2, 3, 4 is not going to get you the same ownership percentage. So, people who invest in seed, they're playing an incredibly risky game, because most of the companies just won't work out. And that's just a reality of business. In the later stages where you have like those huge, like the guy who paid for all those kids' tuitions at Morehouse, Vista. I mean, his thing is like private equity. He's making bets on, companies that are huge, humongous, right before they go IPO or for those sorts. So there are different games to play on each of the ends, but really, a thing that you got to be careful about as an entrepreneur in the earlier times, related to, your initial investment, is that depending on, like I mentioned about terms, depending on what those terms are, they can kind of carry through the rest of the ownership. So if you kind of got some bogus terms initially, the next investor who sees that that's a good deal for them as an investor may be like, well, I want the same thing that this guy has. I'm going to put in way more money for this to happen. And so you got to be careful about those kind of things. But, typically people are raising, early on you get smaller amount of cash, whether it's $100,000 or something. It's typically going to be a percentage of a smaller valuation. From it probably arguably could, last you from 12 to 18 months. And then at that point, you'll likely need to raise another round. And that's part of us talking about, again, knowing when you're going to run out of money at all times. And then from there, you're essentially shrinking your ownership each time. So maybe the first time you gave up, 20% of the business or 30% when you first raised. And then the next time you give up 20%. So 20% of, that 70 or whatever you owned is reduced. So now you own less than 70 that you did in the first round. And it continues that way, depending on how much you actually give up. So how many more shares you issued as a percentage, overall kind of related to what the ownership, what the valuation is. And even though you may own less of the business, you may still value-wise, of course, have more cash, overall, unrealized, of course, but, so it's not always a bad thing. But as these rounds continue, right, we talked about the earlier ones being smaller. Later, when you have less shares than everybody else, or there's like a few investors that, outweigh you, you don't have them over 50%. They have you over 50%. Again, those terms in the initial agreement and in the subsequent agreements that follow that are outside of the cap table will dictate even a whole lot more than just their ownership percentage. So just keeping those things in mind. I do think it's usually typically a little bit simpler initially because you got maybe one or two investors and it's pretty straightforward, but it can get messy fast and you really have to maintain a lot of relationships and expectations about stuff and
organization.
Thank you for listening to this episode of Back to the Basics, powered by Thrive. Be sure to subscribe, follow, and share this show with your fellow first-time founders. You can find this episode along with resources and tools discussed at squareoneschool.com/content. And for our next episode, we sit down with Jose Vietes, the co-founder of Boomtown Accelerators, to talk about how to scale your startup in the most equity efficient way possible. See you soon.